Okay, good. So let's continue with where we left off. Yes, in the previous session, we essentially finished off with this equity investing styles discussion. And as you will see, so please check your notes regularly and please review all your notes regularly, because the way these notes are prepared is in three steps, three phases. Before the class, I prepare the notes a little bit. And during the class, I write in the notes, as you can see. And then very often I will go back after the class and I will look at the notes and see if it's going to make sense for the students. So then I will keep on adding. Then I will keep on adding I can keep on adding stuff towards the end, okay? I mean, after the class where I will add in. So don't just assume that the notes are whatever we entered in the class, because I may go back and add some material. I may go back and add more material to make the notes clearer, etc. So keep checking the notes as you study them. So we finished this equity investing styles discussion. And just to place things in context, we were in this whole DP4 solutions. The DP4 is obviously with the buy-sell bias decision problem, all right? And under that, we were obviously looking at this, if we go back to your calc file, let's go to your calc file. Yeah, under the calc file, you have a DP4 sheet. And in that sheet, you can see that where we had given you this important perspective on the buy-sell decision problem, how you solve it, what are the theoretical frameworks used. And there's two different approaches. One is the value agnostic, which we haven't come to yet. And one is the value versus price. So we explained the theoretical framework here. And one type of this approach, one variant of this approach is what we call forecast-based valuation, which you have done in your first-year finance courses. And essentially, that's what we refer to as fundamental analysis, all right? So we had the discussion on FA, and we talked about various equity investing styles. Now, towards the end of the class, if you remember, we had a discussion on okay, so I think here itself, this is where we were. Towards the end of the class, I asked Varun about what do you think are the critical assumptions, okay? There is a part where we asked about the critical assumptions. I'm trying to figure out where that is. Maybe it's in a separately hyperlinked file. Maybe it's under equity investing styles. But if you remember clearly that we asked about the assumption about what are the critical assumption of, so let's open this file again. I asked Varun about what do you think is the critical assumption of a value investing kind of approach, which we discussed as a mean reversion kind of approach. And one of the answers he gave, a part of his answer was that eventually the critical assumption, this is the part that I had asked Varun the question. And second part of his answer was that this eventually what you do, so let's look at a chart now, we'll make it clear, it'll become clearer for us. So when you use these Yahoo Finance charts, if you're looking at long-term data, one of the things you have to be real careful about is the thing may play tricks on you. Please look out for this at the bottom right of the chart. There is this, you might get a signal with these two arrows, a symbol like, which means the data set is not complete, okay? So you need to keep clicking on it. Now you see there is no such symbol of two arrows, which means now what is true is that the end of the data set is the current period. Up until the time that I was seeing those two arrows, and what it was saying to me was that the end of the data set shown in this chart is not the current period. That is the last point in the data set. When you get no such sign, that means now you've got a current chart, okay? Because there's some problem. I think they've made a mistake in their programming and they're not able to show all the data properly. So this is what you see. So if you see, if we go back to this, so we discussed this question of, we assume that the fair value is, go back here, to FCX, and then the assumption, the answer that that Varun gave was, to look at 5 years to get this, yeah. So that if we feel that the fair value of FCX is $20, and we notice that the market price is around $16, so we go back to our framework and we see that the price is below the fair value, and therefore this is in that framework that we use. in this framework, this is actually, I don't need the timetable actually. Shut this off. So in this framework, because price is below the fair value. All right. Now, in this framework, we have, so therefore, because the price is below the fair value, the framework tells us to buy, and that we buy. And therefore, I asked Varun, what is the assumption here? What is the implicit assumption here? Obviously, the implicit assumption is what we have written down here under equity investing styles. Very important to understand this, because and this is true of every kind of methodology that you apply in every field. Okay, always try to understand, right? And in many cases, the assumption may not be explicitly stated. So let me highlight this key assumption, and let me also tell you that this is not just in finance and not just in this. Everything you are doing in your life, even in a broad sense of life itself, whatever you're doing, always try to understand what are my critical assumptions. What are my critical assumptions? Sometimes they very often may not be explicit. Okay, so try to understand what are my critical assumptions, which basically justify the action that I'm taking. And this applies to every field. So here you see, it is not explicitly spelled out, but the critical assumption is that if I'm buying when the market price is below the fair value, there's a critical assumption in order for me to succeed with this method. That so the critical assumption is basically the assumption that must hold true. Okay, let me explain this theoretically here. Let me write down the theoretical definition of the critical assumption here, key assumption, which is that so not very elegant writing, but let me just write it anyway. What must be true in order for me to profit by using this method? Okay, so this is what we mean when we talk about what must be true. Okay, that is what must be true in order for me to profit by using this method. That is what I mean by critical assumption. Okay, so in any method that you're using, always try to understand what is the critical assumption, because in many cases that assumption may not be explicitly stated. As you see here also, it is not stated. Now, as I said, and from there we went on to the discussion. I'm recapping it a little bit because this is a very important thing for you to understand. And in many cases, it will not be explicitly stated. And you should also understand this general principle. Anything you're doing in any field, okay, understand what you're doing, because you're always going to be following some kind of policy or some kind of plan. And you have to understand what is the critical assumption in this plan, which is basically you ask yourself the question, what must be true in order for me to profit by using, because nobody wants to lose. We are always doing things because we want to profit. So in order to profit, it must be true that eventually the price will move to fair value. Okay, that's the critical assumption. Now, this is only an assumption because obviously there is no, as I said here, need not hold, and then we discussed about Keynes. So there is no guarantee. You have to understand that there is no guarantee that this assumption will hold, that it will go there, because it can just turn around from tomorrow and start going down, and there's nothing you can do about it. Okay, because I make you guys play in very liquid markets. And one of the features of liquid markets is that nobody can influence the price. So you will just be sitting there helplessly, and the market will keep on declining, and there's nothing you can do about it. All right. So that's why this is so this is what brings us to our next topic, okay, which is FA versus TA. Okay, so this is basically our main topic for today. So the reason I went into this long discussion is I wanted to set the context to bring us to our next topic. So when we open this hyperlink, it's also in your notes folder. All these hyperlinks which are there in the notes, you will also find them in your notes folder. Okay, so under your student notes, you will see all these notes. They are not very well organized, but I think the best way to approach it is to go through your session notes and your calc file, etc., and your notes master. This is the best way to approach the material in the course, because everything is given over here. Okay. So, and as I said, if you think something is not clear, it needs to be better organized, please feel free to give me your suggestions. Okay, because all this is done for the benefit of the students. If it is not helping the student, then there's no point. If you have better ideas, give me suggestions and I will incorporate them. Okay, so when we open the sheet, here we find FA versus TA. Okay, now this font is very small. Okay, um, can you guys read this font? I don't think you can read. Can you read all the stuff here? Let's ask
Yes,
some.
sir.
You can read it, Mitali. You can read it.
Yes, sir.
A weak implied assumption. Okay, so that's very good. So then that we don't need to actually, it's so small that even I can't read it on my own screen. Okay, but anyway, so let's understand this first assumption of, but let me just make it a little bigger just for my own. So it's not going to look so pretty now because right now it is organized nicely. We are trying to understand the differences between FA and TA. And so that basically, that you can see in your session notes. This is your essentially a next topic basically, okay? And that takes us to, so that's why I recapped this from the previous session. And this is going to take us to, because the first difference in FA and TA is going to be related to this point. This assumption we call market rationality, which is the assumption that the market price will eventually return to my estimate of fair value, that here in the FCF, eventually it will move to 20. That is basically what we call the assumption of market rationality. And I just once again, just to be clear, why are we having this? Why is it very important to understand the distinction between FA and TA? Okay, why is this important? Because one of the things, one of the problems that you might find when I've told you that there are two basic approaches to solving the the buy or sell decision problem. Now, one is basically comparing value versus price, and one of the sub branches of it, one of the most commonly used approaches. This one is, I mean, used in very specific situations. So, forecast-based valuation, or FA, fundamental analysis. All right. So, and the other is TA, or technical analysis. Now, one of the basic questions that may arise in your mind as a student is, well, which one should I use? Should I use this one or should I use that one? Okay. Now, once again, this is related to your belief system about the markets. That's why we make you do these live projects, which helps you to see. Now, these are not simulations. These are actual market prices. Nobody knows what's going to happen. All the uncertainty is playing out in front of your eyes and my eyes, and no one knows what's going to happen. These are real market prices, real commissions. So you get to see how markets actually move, and you make up your own mind. There is no right answer here. You make up your own mind as to what you think is the true nature of markets. And based on that, you will be applying either this or that. Okay, so I'll tell you a little story also about this in terms of how to choose. But let's understand this market rationality. So this is why we are having the discussion about FA versus TA, because eventually you guys need to make a choice between, which method are you going to use, right? So that's why we are going to this discussion of FA versus TA. Let me just, I can't even read my own. Okay, so I'm going to make it very big, so it's not going to look so nice anymore. But at least I'll be able to read it. Okay. So the first point on which we are going to discuss this difference is what we call, so there are many differences. As you can see, there are four major differences between FA and TA. And so you need to understand this because that will help you to choose the method that you want to use. Essentially what will happen is the method that you will use is the method whose assumptions you agree with, okay? So it's essentially like, should you be a Buddhist or should you be a Christian? Well, you study Buddhism and you study Christianity, and then you eventually make up your mind, okay, maybe I agree more with Buddhism in that sense. In that case, you go and become a Buddhist. If you agree more with Christianity, then you become a Christian. So that's basically how the framework, okay? So there are four differences: market rationality, these are the points of difference, cyclicality of market prices, what kind of explanatory variables are used, and informational efficiency of financial markets. Okay, so you can read this as there are some different assumptions about informational efficiency of financial markets. So we'll explain all these points in detail. But the first point you already understand. The first point of difference is the assumptions relating to market rationality. Now, once again, let me explain what market rationality is. We already have it here, I think. where did I write the market rationality part? It's in the equity investing styles. And this is the part where I've said, okay, so this critical assumption, okay, I'm going to put this I put here, this is the assumption of market rationality. I'm going to put it in the other one also, okay? I'm going to put it in your equity investing styles note also. So the market price will eventually return to my estimate of fair value. And let me put this in some colored background so that people understand that this is important. Okay, what color should we use? Okay, let's use yellow. I think yellow is too bright. I'll use blue. Cyan. Okay. All right. So this assumption that we talked about, okay, is what we call the assumption regarding market rationality. So rationality, we already explained earlier in the discussion when we were discussing Keynes's quote, that market remaining irrational means the market price is not equal to my estimate of fair value. Always remember, fair value is subjective. My estimate different from everybody else's estimates, okay? And all estimates are likely to differ because everything is subjective. They are based on individual forecasts of cash flows and where there's no right answer. At least ex ante, we don't know what the right answer is. Okay, so coming back here, we put this thing in color because it's very important. So market rationality. So in FA, when you're using FA, so let's look at our table here. So in FA, we assume that market prices, so basically in FA, we assume that market prices they are rational. We assume markets are rational. So that essentially what that means is that market prices must at least periodically return to value. Okay, value means here, wherever you see value, value means fair value. Okay, rational pricing. So when rational pricing is when market is equal to my estimate of fair value. Okay, that's what is called rational pricing. And when that is not true, we say the market is irrational. Okay, so this is an assumption of FA, and just briefly let me explain. So fundamental analysis, as we have already discussed. Okay, this is basically it's all related to microeconomic. I think somewhere here I have discussed this. I put in some notes about where what fundamental analysis involves. Okay, macro and microeconomic analysis, firm level, macroeconomic level. Or maybe it's in your session notes in this DP4 part. Okay. Yeah, so microeconomic analysis, political analysis, weather analysis, like you'll be doing a project in IFM where you'll have to manage risk in oil prices. So you'll have to trade in oil, which means that you have to start looking at what's happening to the weather, what kind of, this we discussed already when we discussed this. So all that is fundamental analysis. And here we assume that market prices must eventually return. So sorry, what I was talking about is this, that these two terms, okay, this is what is used in industry, FA and TA, okay? So people say fundamentals and technicals, but actually if you notice, these terms are they are bad. These are examples of bad nomenclature because they don't really mean anything. In the sense, it's not really telling you anything about what that method is, okay? So if you wanted to have names which were more illustrative of what the subject matter is, these are the names that you should use. Okay. Actually, what we mean when we use FA, this is what we mean: economic and financial analysis. Because that's what we are doing. We're doing microeconomic analysis, other kinds of financial statement analysis, accounting policies of companies, this and that. All that falls under this. So if we had used this, but obviously, this is the correct method. So. But this is what people in industry use, FA and TA. So when you go into industry, you have to talk about FA and TA. But you should always understand in your mind that these terms are not very good because they don't tell you anything about what is so fundamental about all this. Fundamental is a very general term. Technical is also a very general term. In fact, in the IT business, there is a job description called technical analyst. So when you see job ads for technical analyst, it may not relate to financial markets, it may relate to IT. So this also what is technical. Technical is a very general term. So these are bad terms, but this is what industry uses. So you can't go in and start talking and saying these economic and financial analysis and price trend analysis. But this is what you should understand in your own head, that these should be the right terms. Okay, that also teaches you about if you're ever coining a new term, make sure that term is illustrative of what you're actually labeling, right? So if you're making some pasta, if you're making a pasta dish, don't just call it food, you call it pasta, okay, or white sauce pasta or something like that, so that people know what it is. Just saying food doesn't mean much. So okay, so this is the explanation that I wanted to give you, that basically this is what we do in FA and this is what we do in TA. We are doing price trend analysis. So in FA, on the question of market rationality, FA believes that yes, markets are rational, which means markets must eventually periodically return to fair value, that this must eventually go to my estimate of fair value. Okay, that is important. Always never forget, because in the markets you'll see people talking about, yeah, markets are overvalued. Yeah, you think it's overvalued? And everybody nods. Yeah, I think it's overvalued. But actually, this discussion is quite ludicrous, because everybody's estimate of fair value is different, and everybody's nodding. Ah, yeah, I think it's overvalued and all that. Without explaining what their own estimates of fair value are. So you'll see a lot of discussions in the markets are kind of stupid, but you still need to follow it, because you are very new and you need to learn about things from, you need to know what the market talks about, basically. That's why you need to follow this. Now, here comes TA. Now, on the question of market rationality, this is what TA believes. Let me F2 this stuff so that you can read it, okay? Now, F2 basically is, as I said, F2 is value agnostic. So not F2, sorry, TA, okay? TA is value agnostic. Remember, TA is listed as a method, which is, if you go back to your calc file, TA is listed as a value agnostic method. And agnostic, as I told you, agnostic means I don't know, I don't care. Okay, so like people who are religious people, they firmly believe in some kind of God, either Jesus Christ or Vishnu or Muhammad or whoever. And people who are agnostic about religion, about God, they basically say that, I don't really know whether there's anything called God, and I'm not really bothered actually. It may be there, it may not be there. I'm not concerned. So that's what agnostic means, okay? Not really clear. I don't know, and I don't care. So in this context especially, it's basically I don't care. So here in TA, we are value. So TA is the value agnostic method. Understand this, the fundamental difference between FA and TA. So these are the differences that you have to understand. So when you are doing a choice, when finally you have to decide whether I should be using FA or TA in my approach going forward, not just in this project. In this project, you're just learning, and mostly you'll be using TA because you won't have time to use FA. But in the real world, you will have more time. So you need to make a decision. And the way you should make the decision is, I'm not going to tell you which one to use, but I'm going to tell you how to make the decision. So you will study this, you will see that in TA, we don't assume anything about market rationality. We don't assume that the price has to come back to fair value. We don't make any assumption about this having to come back to my estimate of fair value. All right. So therefore, what you will do is when you're making this choice, okay, whether I should use TA or FA in my approach, you will have to study the market as you see it. Okay, that's why I make you do all these live projects. You are going to have your own experience of how market prices move, and you're also following market news. You can see all the economic data coming in, all the COVID information coming in, and you can see what the policymakers are doing, expanding money supply, this and that, and you can see how markets are reacting. Okay, so like a couple of days ago, there was some slightly negative news on the US front for the vaccine, when the vaccine is going to be ready. So the market crashed from its very high levels. And then yesterday there was very good economic data, jobs data in the US. Okay, so that led to a rebound in the market. So the market is reacting in a way to economic and various types of news. So you figure out for yourself, do you think, which assumption do you think is correct? Okay, you don't have to take anybody's word for it. You have to form your own view. Okay, and so you figure out, do you think markets are rational, and do you think markets are not rational? And based on that, so obviously if you think markets are rational, then you will be inclined to use this. And if you think markets are not rational, and you don't think of your approach, you don't need to worry about market rationality, and basically you don't see any reason to believe that markets are rational, then you apply TA. Okay, so here I'll give you a short story about myself, which will help you to also decide. Okay, where we are talking about FA versus TA. I'll put it here itself a little bit. So now, when I first came into the market, like when I was in IMA, I already decided in my end of my first year I was going to do FX trading. Okay, so I had a background in I was an economics grad. Okay, so I thought that I would do lots of economic analysis. So I believed in FA. Okay, most people generally, when they start out, they believe in FA. Okay? Because this is rational, and we like to believe that everything is rational. So I also believed in FA, and I thought that I was going to be a good FX trader, because I have a background in economics, and I was going to do all my macroeconomic and microeconomic analysis, and therefore I would be able to come out with good forecasts, and then I would trade based on those forecasts. And then I would actually buy sell, okay, based on those forecasts. Okay. Now what happened was, when I went into my first job, which was a trading job with American Express, I was actually on the foreign exchange trading desk. Now what I found was, okay, so when I'm on the foreign exchange trading desk, now I read a story about there's a guy in New York, okay. So the New York trader, what he's doing is, sits in a room, no news feed, okay. The guy gets no news feed, and he sits in a room, only charts, live charts, of course, only live charts, okay. So I read this story in the Wall Street Journal or somewhere. So the guy in New York is sitting in a room with no news feed, which means he doesn't know anything about when the economic data is coming out and what kind of information, whether the unemployment rate is new rate is higher or lower, anything, no information, only live charts, okay, and he's trading and quite profitable, okay. So now when I read this story, I read it very early on when I entered the trading room. Now I thought this guy must be crazy, okay. This is what I thought, okay, because in my way of looking at things, I was actually implicitly, I didn't realize that at that time, but obviously I was implicitly in this camp, that I believe that markets must be rational, and that there must be some kind of estimate of fair value, and that markets must eventually come down to that estimate of fair value. So in that case, obviously you need to do some kind of, if you notice here, in TA, there is no method for arriving at fair value. Okay, if you want to do fair value, you have to be in this branch of the tree, and either you use AFD, which we have not yet discussed, or mostly you use some kind of FA. All right. So, and you can apply this bonds, stocks, currencies everywhere. Okay, any asset. So that includes currencies. So that's what I thought I was going to be doing. And so when I saw this guy, I thought he must be crazy. Okay, but in fact, what happened is that my own experience, okay, own experience of markets within 6 months, less than 6 months, okay, in less than 6 months of seeing actual live markets, okay, convinces me that, convinced that, what am I convinced? I am convinced that markets are not rational. Let me see if I can save some typing. I'm just trying to save some typing. Okay. All right. Where are we? Okay. I'm convinced that so based on my example, this assumption is not true. I need to make this bigger. remove the background. Okay, this assumption is not true. Okay, so this is how it works. Okay, so the reason I told you my personal story is that it may also help you to take a decision. This is a very important decision. Okay, anybody who goes into financial markets as a career, and not just in financial markets directly as a trader, even if you're a treasurer, you're managing risk for, let's say, Mahindra and Mahindra, they have a lot of raw materials to buy, whether we should buy the steel right now, or should we stock up on 6 months of steel, because, or should we lock in 6 months of forward steel purchases because steel prices are going to go up. So wherever you are in finance, most of the finance roles will require you to take some kind of view on markets, all right? Which means you'll have to basically you'll have to face this problem in most finance roles. This relating to financial markets, should I be a buyer or seller? You don't have to be a trader. Even other finance roles will require you. So therefore, you need to have some kind of plan as to whether I'm going to be using FA or I'm going to be using TA. And so therefore, this is very important. So everybody will have to make this decision, all right? So that's why I told you my own story. So that will help you hopefully to decide, and it helps you to also understand the process. You don't have to come to the same decision that I did, but at least you can see the process. So in 6 months, I went directly from, it's a radical change in 6 months. When I came in, I thought this guy sitting in a room is totally crazy without any news feed. Okay, no news feed. And in 6 months, I understood why he didn't have any news feed, because I could see from my observations about markets. Okay, if you look at FX markets, you look at any market. Okay, I don't want to change the chart right now, but if you look at any market, I could see that time what we had. Let's look at some FX markets and see. So the reason I'm going for Swiss franc and not euro is because the euro actually came in 1999. So we have long-term data on the Swiss franc. So there's you are, 1994. I started in the markets in 1990. So there's actually even before that. So it doesn't have that much data. So yeah, so here's an example of a market that I used to trade, this dollar Swiss franc. And so all these up and down movements, I realized that this assumption of market rationality is not true, because usually we would be doing some analysis about the US economy and the Swiss economy and trying to figure out where the dollar should go based on the relative performance of the two economies, interest rates, inflation, this and that. Then within 6 months of watching market prices, I understood that this is all rubbish. The market is completely crazy. It doesn't have any kind of rationality. I understood that after watching it for 6 months, okay? So there's a totally radical change, and that's when I became converted to, at least definitely for currencies, okay? I believe that there's some element of FA can be applied in debt, in equities, a little bit less. So we can have a discussion on that later on. But the bottom line is that my own personal investing philosophy is, if there's any conflict between the FA and the TA, I will go for the TA decision. I may apply both, okay, depending on the asset class I'm looking at. I may apply both, but in currencies and all, I will just apply TA, okay, because I don't think FA really has. Yeah. Yes. Yes, Aman. Okay. All right. Okay. So so in currencies, I would apply only TA, but in debt, I would apply. I think in corporate credit, there's more role to be. There's more of a role for FA, and you really can't apply technical analysis because the markets are not so liquid. So you have some gradations there. But the main thing is that based on this experience, I came to the conclusion that this assumption is not true. Now, you may have come to a different conclusion, all right? So this is what I'm telling you here. The reason I'm showing you all this and discussing this story is that it gives you a template for how you can solve this problem. Because this is another problem. If you remember earlier on when we were discussing decision problem, Utsav had mentioned that this was going to be one of the decision problems. Should we use FA or TA? So then I told him that this is actually a sub decision problem under the high level problem of buy or sell. okay, which method you choose, but he was correct that this is also going to be a decision problem, but it is subservient to this decision. Okay, so but this is a decision you need to take. So you can do this for yourself. That's why I'm making you do these live projects. You will be watching the actual live market price movement over your next over your 3 projects, and towards the end of the course, towards the end of your MBA program, you might have a much better idea as to uh, whether this assumption is true or not. Okay, so this is the first assumption, market rationality. Anybody, any question? And so, and therefore, I just um, so I switched to a TA preference. Okay, strong preference for TA, because if in every market which is liquid, I don't know how, I'm not able to spell preference. Okay, let them correct it. Okay. Okay. All right. Okay. So this is the thing. So anybody, any questions so far about what I told you and understanding this point about, we are now on this first point. Okay. We're going to go through and understand the differences between FA and TA. And the first point we have discussed, that in TA, we don't assume anything. We don't assume that there's any particular, if I have a fair value of dollar Swiss at 1.4 and the current level of dollar Swiss is 91.30, there is no guarantee that this market will come here eventually. The market can remain irrational. It can, and the market basically doesn't care about any kind of somebody's estimate of fair value. It just swings up and down in a, basically in a not in a in a method, in a manner which you cannot really pin down to any kind of rational behavior. Okay? So the market is not rational. Essentially, we don't make any assumption about market rationality in TA. Okay? That's the difference. So this first point of difference, does anybody have any questions at this point? Make sure you understand this, because you will not find the differences written like this in any book. Some of the differences they will write are slightly lower level differences, which are not theoretically the correct ones. So this, if you understand these differences, it will help you to make a wise choice. Essentially what you will do is you will look at these principles of each of the methods, then you will apply, you will observe actual market prices in your project trading, and also independently when you're watching television and watching TV, following the markets. You will independently observe the markets, and then you will decide for yourself whose assumptions are more accurate based on what you have seen of financial markets. Okay, to make sure you understand all the points clearly. Any question about the first point? Okay, while you make up your mind, I'll just okay. Second point. This is where we go into a long discussion also. Let me briefly explain, and I'll give you the notes. You will see that here, under your DP4, all this discussion is happening under DP4. Okay. Now, under TA, the next assumption is so we are discussing TA. The next point is the cyclicality in asset prices and trend definition. There's a file here. Okay, we can open this file. It's also in your notes. Now, if you just read this document, or it will not make much sense to you. Try to understand it first. I try to understand what I'm saying, and now we can record the video and share it with you, so that so I'll upload the video by the end of the day, and I'll put it in your file, so that you can make sure you watch it. So make sure you understand what I'm saying in the class, because the notes are written in a very technical manner, because they are written to be self-sufficient, so that if you if you read the notes itself, you will understand everything. But the point is that the notes are kind of they may sound a little technical. They may not be easy for you to understand. So if you don't pay attention in the class and ask questions, you may not understand the notes as they are written. They may seem very abstract. Okay, so therefore please pay attention. So we are now discussing the second point, that essentially what is the difference that when it comes to this question of cyclical movement of market prices, that is, do market prices move in a cycle, in cycles? Okay, like this first point was market rationality. So both these methods, they are asking, are market prices rational? Are markets rational? Okay, are markets rational? Same question here. Here the answer is yes. Okay, at least partially, at least periodically, they must return to my estimate of fair value. Okay, and then here the answer to the same question is no. I don't see any evidence of that. Okay, so I'm not going to come to that conclusion that markets are rational, but I don't see any evidence that even periodically that they return to fair value. I don't see any such evidence. Okay, the TA guy, this is what he believes. Now this is the second point, cyclicality. So ask yourself, do market prices move in cycles? The FA people, like the TA people on this point, they say, well, I don't really have a strong view on that. I don't know anything about that. I don't need to make any assumption about, whether or not market prices move in cycles. I'm not making any such assumption as such. Okay, so there is no strong. They are kind of almost agnostic on it. Okay, so that's why I've said here the answer, because you'll be studying from these notes. Okay, you'll be studying from these notes. So therefore, I want to make sure that you understand what is written over here. So this is basically what I'm saying, that there is no explicit assumption that market prices move in cycles. Okay, unlike, say, for instance, rationality. In FA, there is a very explicit assumption that market prices must at least periodically return to value. Okay, value here is my estimate of fair value. Okay. My means, obviously, when you're doing it yourself, I mean, this is not when you're applying this method. When I say my, you're not thinking of what is Ram Sen's estimate of fair value. In this case, you replace my with, that becomes you then. Okay, so the individual investor's estimate of fair value, which is different for different people. Okay, so on cyclicality, the FA people don't have any explicit assumption about market prices. Okay, what I have written is that a weak implied assumption may be inferred from an acknowledgement that markets often depart from rational pricing, and that markets eventually return to rational pricing. So, I mean, basically, what I've tried to explain here in these few lines is that. So, if I say, let's go back to the FCX example. Right? If I say that that my estimate of fair value is $20 and current market price is $16, so I will be a buyer because I believe that eventually markets will return to my estimate of fair value. Okay, now how will they return? They will have to move from this level eventually back up to this level. So in doing so, there is some kind of an uptrend. Okay, and as we will see later, this uptrends and downtrends actually make up a cycle. All right, so you could say that there is some kind of a weak implied assumption of cyclicality, but since cyclicality is a very important feature of markets, and since there is no explicit assumption, we will go with the view that broadly the answer of the second question is no. In FA, the answer is no. There is no explicit assumption about market prices moving in cycles. But now look at TA. Okay, very important assumption in TA that prices, if you read other books on TA like Murphy and all that, you will find that the assumption is written as market prices move in trends. Actually, this statement is not at the right level. The statement should be that the market prices move in cycles. And as you will see, when you have a cycle, it has to consist of uptrends and downtrends. So if you say cycles, that's a higher level designation. And that is how the assumption should be stated. Okay, so let's understand this. So broadly, what is it? Now I'll explain what exactly it means. But first, let's see the high level answer. That when you ask the TA fellow, do you think market prices move in cycles? He will say yes. Okay, that's what. So these guys believe they move in cycles. Now what does that mean? You can already see it here. Cyclical movement of cycle of market prices. Very good example in FCX itself. Everybody knows what a cycle is. Okay, if you go to your note on cyclicality, okay, asset price cyclicality. So all of you have seen the sine wave. This is an example of a, you may remember this from your math class, okay? Sine and cosine waves. So basically you get the picture, okay? So what we are saying is, this is the idealized cyclical movement, very uniform, okay? Height is the same, and they're touching down at the same intervals. Everything is uniform, nicely uniform, and very nice, smooth kind of patterns. But the main thing is, goes up, turns around, comes down, turns around, goes up again, turns down. This is the pattern. This is what we mean by a cycle. So we can stop this. Now we can see in real life. Now remember, that sine wave is generated by the function, okay? But here there is no function as such. There is no ex ante a priori function. This is just markets are playing around with the price of FCX, and look at the patterns that emerge, okay? You can see, obviously, there is a clear tendency towards cyclical movement of prices. You see, low goes up all the way. If you just look at the big moves, the low here goes up all the way, high, then drops, low, another high, another low, smaller high, smaller low. Okay, so you can see clearly that there are cycles in the market. Okay, so this is what people in TA believe, and this is true. You can look at any chart, you can look at any kind of market. If you want to look at, I just showed you dollar Swiss. If you want to look at, say, dollar yen, we are looking at some currencies. If we look at, maybe if you look at all, here also you can see it. This is US dollar, Japanese yen. If you see the long-term charts, you'll see some long-term trends. Once again, low, high, etc. So this is basically the assumption, okay? In TA, we assume that market prices move in cycles, and hence in uptrends and downtrends. Now let's look at this node a little bit, okay? If you see here, what is written here, you can read this text later on. I'm not going to explain everything in the notes. You can read it. And obviously, if you read it, and if there is any part that you don't understand, it is your duty to, ask me that, I didn't understand this part. Can you write it a little better? Or can you explain it to me? So unless you do that, I'll assume that you understood it. Now, this is, as I said, if you don't understand, if you don't pay attention in the class and understand what I'm saying, you may find the note very abstract and technical. Okay. Basically, it's a cycle is about 4 parts. So these are the other properties of cycles that we'll come to. So essentially, let me just point out this. I'm just trying to make sure I follow the notes and explain the broad parts of it. Okay. So you have an uptrend and a downtrend, and what we are saying here is, you can look at the cycle. You can either measure the cycle. Let's look at FCX. It's got better cycles and more data. It's basically got more data. Okay. So you can either measure the cycle from low to low, right? Or you can measure this. You can either measure the cycle from low to low, or you can measure it from high to high. All right, so what have I said here? Just want to make sure I follow the notes. So that's what we are saying, the first part of the note, that basically this, okay, so if it's high to high, you find out how many years, if you think that this cycle, and one of the things you can see is that the cyclicality is a repetitive feature, okay? It doesn't stop just one cycle here and then after that it starts squiggling around randomly. That's not happening. There was one cycle low to low, and then later on you see there are more cycles happening, okay? So it's a regular feature of markets. So you can talk about forecasting on the basis of cycles, and you can say that if you say take this high and take this high, they're not exactly the same. Obviously in the real world it would not be like a sine wave. So you take this, let's say this is 2008, okay, and this is, I'm not looking at the months, just giving you the example, and this is 2010, okay. So if we say there's a 2-year cycle, then we say there's a 2-year cycle high to high, okay. So now what we expect is that every 2 years there will be a major high. So what you'll be doing is, the way you use cycles for forecasting is that you first make up your mind as to what is the dominant cycle in a particular market. Okay, so I'm just giving you an example. Okay, let's say for the sake of, in the case of FCX, you come to a decision that every 2 years there will be a major high. So now you will project forward from 2010. Let's say we are in 2010-11. Okay, this is where we are, and all this stuff hasn't happened. So we will predict that in 2012 there will be a major high. Okay, that's what we will do. Again in 2014 there will be a major high. Okay, and you can see here there was something. I'm not trying to say there is a 2-year cycle because I've not even analyzed it properly, but I'm just showing you how the analysis will proceed. Okay, so this is how we use cycles for forecasting. But at this point, we are really trying to understand some of the properties of cycles, because it gives you a very good understanding of TA, and it will also lead to a basic technical approach that we will be teaching you to apply in this project, hopefully, which you can apply in this project. Okay, so here we have this part we have already, this, as I said, is not as neat as the sine wave. Okay, so each completed cycle will have one uptrend and one downtrend in any order. Okay, which is what you see. If you look at this cycle, low to low, one uptrend, one downtrend. So, and that's what I've said here, that in the case of a low to low cycle, you have a uptrend first, then the downtrend. In the case of a high to high cycle here, then you have the downtrend first, followed by the uptrend. Okay, so that's the first part of the note. Okay, so this is, as I said, presence of cycles and trends is one of the key assumptions of TA, because you will see that everything we do in TA requires the market to move in cycles and trends. Obviously, if you say cycles, it automatically includes trends, because there are only two types of cycles: low to low or high to high. And in both cases, there are uptrends and downtrends, okay, in any particular order. So most technical methods, pretty much all technical methods, essentially require the market to move in this manner, to move in cycles, in order for those methods to be successful. That's why we say that this is a key assumption of this method of TA. Okay. So now, what is the next point on this note? Okay, so the first thing you notice is that any market you look at, let's look at oil prices. So we looked at currencies, we looked at equities. Now we look at crude oil. Here also you can see there is a long-term cycle. This price is actually a little bit, because it's based on the front month futures price. So it's a little bit of a, almost, it did go, the futures contracts actually went negative. But those are slightly a bit of an aberration kind of a situation, but it's basically near zero, right? So you can, here also you can see cycles, okay? And so even in crude oil, you can see cycles. If you go for copper, you will see, I wanted to look at the CFD of copper. Well, let's look at copper futures, fine. Let's look at the continuous contract. Okay. Here also you can see there is a cyclical pattern. Okay, you can notice that. So anything you look at, you will find that this is true. Okay, the cyclical movement of market prices is true. We can apply any kind of chart, and you'll find that if you apply, let's say, for instance, Dow, you will see Dow is a new chart. Okay, so let's use General Electric. Okay, here also you can see in General Electric, major company, and you can see how there is cyclicality in their prices. So everywhere you go, you will find this. Okay, so that is the first part. that this is the assumption, key assumption of TA, and by and large you will find that it seems to be true. Okay, uptrend, downtrend we followed. Okay, now we said four components in a cycle. Okay, which is now we are going into the properties of cycles and asset prices, because this will lead us to our method. Okay. Now we are trying to teach you, as part of this itself, we are trying to teach you FA, trying to teach you technical analysis. What I will do is, I think I have a couple of choices. I can either go through briefly what the differences are, and then I can come back to this to lead you to the method. Okay, I think that would be a better way rather than going directly into the method. Since we are in this topic, let me go through quickly, just at least superficially, the points of difference, and then I will come back, because even this needs to be discussed. Here we will go into a discussion of models, predictive models in finance, so that also we'll do later. But I will first go through the four differences briefly, and then I will come back to the cyclicality point and discuss more along the lines of this note, because I need to teach you the method. All right. So here we can see, let's go back to this. So cyclicality. So we have explained what we mean by cyclicality. The other thing I just want to spend a little more time on. Maybe actually I will go up to the first 3 points of this note. In order to understand this point in the FA versus TA, I think in our note on cyclicality, we need to at least cover the first 3 properties of cycles. Otherwise, I think your understanding of cycles is going to be incomplete. So when you look at cycles, if you look at any market, okay, when you look at cycles, okay, let's just look at FCX. You will notice 3 things. So we're going to cover these 3. That there are 4 components of a cycle. Okay, uptrend, downtrend, high, and low. The first 3 points we want to cover. The first point is that there are 4 components: uptrend, downtrend, top or bottom, high or low. Okay, we'll just call it high-low. So this is very easy. I just wanted to write it down here so that you can use this like a textbook, and everything is written down if you want to write anything. But it's very obvious. And I look at any cycle, say I look at this cycle low to low. Okay, I say that this is what, 2000, and this is 2008. So I say that there is a 4-year, there's an 8-year cycle low to low in FCX. Okay, I just make a statement. So what is in that cycle? Every cycle will have 4 components. There'll be an uptrend, there'll be a downtrend, there'll be a high, and there'll be at least 2. In fact, so this needs to be, that's why I said highs and lows. Okay, so depending on what you have in this case, because it's a cycle low to low, there is 1 high and there are 2 lows. Okay, so there will be 4 components: uptrend, downtrend, highs, and lows. So it sounds very basic, but the reason I'm doing it like this is that I just want to make sure, because you guys are all very raw, you're doing all this stuff for the first time. I want to make sure that your theoretical understanding is very solid. Okay, your fundamentals understanding has to be very solid. So even baby steps have to be explained, like the sun rises in the east. That also I'll explain to you so that everybody's clear, that there is no confusion. From very basic first steps or first principles also we are going to explain. So first point here is 4 components. Okay. Any questions so far, anybody, what we are discussing? No questions? Okay. So we'll continue. Let me explain the second point. Okay. Fractal property. Okay. What is a fractal property? Let's understand what this is. The first point is basically this, that there are 4 components. Okay. This third point is constraint. Right. Okay. Now let's try to understand so there's some background noise here. Just put up with it. Now let's try to understand cyclicality. The second point. What is a fractal property? Okay. Fractal means, I'll just write this note here. Okay. Maybe we can, no, I won't put it as a footnote. Footnote, the font becomes very small. So fractal means self-similar. Okay. Basically, it means self-similar. I'll explain what that means. All right, look at this. Now, what are we working with? We are working with the idealized concept of, because what are we saying here? We are saying that cyclicality is a fractal property of asset prices, asset price charts, okay? And this will apply in economic data as well. If you look at unemployment data in the US, you will see cyclicality there also. So what we're saying is it's a fractal property of asset price charts. Now, also understand this term cyclicality. Cyclicality means nothing but, because one of my students in the earlier batches was very confused by this word. I just want to make sure people understand. Cyclicality means just that the property of moving in cycles. So if we say that asset prices exhibit cyclicality, that means that asset prices tend to move in cycles. They have the property of moving in cycles. That's all it means, okay? So cyclicality is a fractal property of asset price charts. What does that mean? Fractal means self-similar, right? Self-similar, what does that mean? It means you take the idealized cycle. So keep the sine curve in your mind. You know that every cycle is going to be approximately, we are not going to have ideal cycles in the financial markets, but sometimes you get something very similar to that, but you're not going to be regular like a sine curve, but you get the picture, going up and then going down, going down, going down, then going up, going up, then going down. So when you look at this kind of pattern of going up and going down, going down, going up, you see that it's there at many levels. Fractal means here, see, what do I do? Fractal means self-similar. So I take a pattern. I look at this large cycle from 2000 to 2008, low to low. So I see it goes up and then pretty much comes down to almost the same level. Not exactly. So I take this pattern which is there in my mind and I try to now apply, this is on a very big scale. Okay? Now I try to look inside this uptrend. Now I try to zoom in and look inside this uptrend. Can I see similar patterns of low to low? It goes up, then comes down. Maybe not exactly to the same point, but goes up and comes down. It does seem like I can do that. See, here I can take one low, another low. I see that it goes up, comes down. So there is a cycle low to low. But obviously, it's not the same, it doesn't come to the same level. Okay, but there is a cyclical kind of pattern. And so then I see one here. I see one more here, low to low. Okay, you could say you see one more here from low to low. Those are very far apart, but there is a move up and then there's a move down to come down. Again, you see another smaller one. Okay, you see another smaller one here to here to here, goes up, comes down. Okay, and then here you can see, so, and then again goes up, comes down, goes up, comes down. Here, of course, this goes much below that. Okay. So the point we are trying to mention here in terms of cyclicality as a fractal pattern, let me try another chart, which I'm trying to remember the name of the company, which had almost like a, perfect cycles. Anyway, so it doesn't matter, but this is also not too bad actually, if you look at FCX. So you understand what I'm saying about by fractal movements, a fractal pattern. So I'm saying cyclicality is a fractal pattern, which means I can take the basic pattern of a cycle, which is up, down, or down, up. I can take the basic pattern of a cycle and I can apply it at different degrees of magnification. See, this is one degree of, if I look only at this, up, down, up, down. If I'm looking at this level, up, one up, two down, three up, four down, and that's it. I don't even look at this because it's too small. Okay. So at this high level zoom, okay, you think of it as zooming in. Okay. So Ketan should understand this better than everybody else. Zooming in and zooming out. Okay. So at this high level zoom, I see only one down, and one up, two down here like this. So I see only two cycles low to low. One cycle here and one cycle here. This is too small. But then I start zooming in, okay? Now I start zooming into this part, and I then start seeing, okay, let me see if I can, maybe I can, one second, let me just try to pull up the Vivekananda chart, which had this nice, split up view, the palette view. But you understand what I'm saying, right? That if I zoom in, and I can, if I zoom into this uptrend only, instead of just looking at this high level, if I just zoom inside this uptrend, I can start to see smaller cycles, okay? You see, it's not going in one straight line from here to here. When I say that there are two big cycles with the high level zoom, I am not looking inside this movement. I see it as one straight line. Now I start looking, inside this, I start looking inside this uptrend. And I see, wow, let's look at this. We got some small cycles going in. Okay, up, down, up, down, up, down. And then even inside this, if I now start zooming in further, okay, you see there are smaller cycles. It goes up, comes down, goes up, comes down. Okay, again here goes up, comes down. So what you can see is cycles within cycles. Okay, you can see that constantly. You'll see that there are cycles within cycles. But here also, if we look at, if I look at this GE chart, okay, and I decide to look inside this part, okay. So this part is from say 2016 to 20. So if I go into the 5-year chart, the decline from $30 roughly, because initially, if you see, initially when I look at this, it looks like almost one straight line, except for this one part here. When I look inside this, I can't see anything much. I can see only one straight line. But if I zoom in, now I start to see lots of smaller trends within this, smaller cycles, high to high, another maybe high to high, okay, another high to high here. So this is what I'm talking about here. When I start looking inside these patterns, so let me try and bring in the Euro chart from the Vivekananda picture also, which I showed you earlier, that you have, long-term, you have various types of, the same market is being shown, but at different time frames and different data sets, longer data sets and shorter data sets, right? So you can see here, so that's what I mean. You see cyclicality here, because you can see, inside this, there is a downtrend. This one is actually, at the high level, this is one straight line down. But if I start looking inside this, I can see down, up, down, up, down, I can see so many low to low, high to high cycles. Now, if I look even inside one of these, okay, if I start zooming in and looking even inside one of these, I will find, which is this part here, I find now, here I don't see anything except a straight line. But when I start looking at this last part here, when I start looking at it here with the daily chart, I can see more. Detail, and I can see smaller cycles, right? I can see smaller cycles here. Okay. Does everybody understand what I mean now? All we are trying to say is, by fractal property means you can take the same cyclical pattern and you can apply it at multiple, same cyclical pattern means uptrend, downtrend, or downtrend, uptrend, okay? And this kind of a sawtooth pattern, okay, this kind of pattern you can take at any level and you can see it happening. The same thing you see happening on the larger scale, down, up, down, up, down, up, down. See, take the same kind of movement, and now you are zooming in just to this part here, which is over here. Now you see again, down, up, down, up, down, up, down, same thing, okay? So that's what we mean by fractal property, that this pattern of cyclical movement, no matter what the level of zoom is, okay, no matter what level of zoom you look at it, okay, using, okay, no matter what level of zoom you use to look at it, you will see the same kind of cyclical movement. We are calling this a cyclical movement, even though it's not a perfect cycle. Down, up, down, up, down. So we say it is cyclical. Okay, right. So that's what we mean by the fractal property. Wherever you go, any market, you start applying. Say, let's take this small part here. Okay, here you have a cycle low to low. You have a cycle low to low. At this point, I treat this as one straight line. When I say cycle low to low, I treat this as one straight line and one straight line. But now if I zoom inside this, I see low, low, low. I see three lows. I see high, high, and high. Earlier I had only one low and one high. So the point is, no matter what my level of zoom, and here you can see different levels of zoom. I zoom into this part, I zoom into this last part here, I see this. I zoom into this part, I see this. I zoom into this part, I see this. Zoom into this last part here, I see this. Then zoom into this part, I see this. Zoom into this part, I see this. And I zoom into this part and I see this. Okay? So this is basically how it works. So at every level, I can see down, up, down, up, down, up, down. Okay. So I spent a lot of time explaining the idea of this statement, that cyclicality is a fractal property of asset prices, of asset price charts. Okay. Now, has everybody understood? Any questions at this stage? Anybody? All okay? Okay, fine. Okay, the last point which I need you to understand. So that now, see, now what is happening is I'm giving you some, this is all theory, by the way. This is all theoretical frameworks, okay, which you use to look at market prices. Now, hopefully, when you look at another chart, you will start seeing certain things maybe which you did not see before. You will start noticing, the highs and the lows. You will start noticing the different levels of zoom that you can look at the same chart, because you will not get this kind of, this is the ideal way to look at markets. But because of our constraints in terms of technology, because this particular software does not have the data feed for US equities, so we are not able to do this with our project right now. But always remember that this is the ideal way. If you go back to Vipul's question many sessions ago, and what degree of chart we should look at, or how much data should we use, or I think, yeah, that was either Vipul or Sachin who asked that question. I think it was Vipul. So the answer to that is, in your mind, you must always keep this. If you have no constraints, this is the setup you should go for wherever you are. If you're trading commodities, trading currencies, this should be your chart display for every market. This is Europe, FCX also you would put in here, Dow also you would put in here, crude oil also you would put in here. Same format. Okay, this is the ideal format, but it may not be possible, so you do it indirectly. Okay, so what I would do here is, what is the point I'm saying? The third point I'm coming to is that they are constrained by smaller larger cycles. I'm just coming to that. That if we go back to our FCX, okay, I go to all, I see this. So what I will do, I see, okay, this long-term trend is like this. Now let me zoom into this last part. This is 16, so let me go to 5 years. Now I'm zooming into this last part. I remember all this, but I'm zooming into this last part and I'm seeing what is happening. Okay, and then I can zoom into this, etc. So now let's come into the last part. I think I got a little lost as to what I was trying to say, but anyway, let's remember that. So I think you have understood what is meant by a fractal property. Third point. Smaller cycles are constrained by larger cycles. What do I mean by this? So, as I said, what I remember now what I was saying when I got lost. That now that I've taught you all this, now when you look at a chart, you start to see things which you maybe did not see before. You start noticing the highs and lows. Okay, you start noticing start becoming conscious about the levels of zoom. Okay, now I understand. If you are able to ideally display in this format, the levels of zoom are automatically set out separately for you. One zoom level, zooming in more, zooming in even more, zooming in even more, and so on and so forth until here, maximum zoom in. Okay, and this is maximum zoom out. This ideal thing may not be possible, but at least even when you're looking at one chart, try to subconsciously try to understand or even consciously be conscious of the different levels of zoom that you can apply in looking at this chart. You can just say this one straight line, down, one straight line, one straight line, one straight line, high level zoom. Then you can now start looking, let's zoom into this part. So start becoming conscious of all these things, okay? When you look at charts, it will give you a better understanding. Charts are very important because, we will come to this later, these are objective. This data is objective. Remember, when you go here, one of the reasons I've always, if in case of a conflict between FA and TA, I would always go with TA because this is much more objective. Remember, the biggest problem with this method is that the assessment, unless you're using this particular type of AFV, proper AFV, in all other cases, the value is subjective, okay? And that is the weakness of this method. And the value is subjective. So therefore, it's very important to understand charts, even if you're using FA, because this is the true picture of the history. You cannot deny this, okay? Unlike fair value estimates, if I say my estimate of fair value is $20, Sachin may come in and say, no, I think it's actually $8. And there's no way to say who is right. You'll never know who is right, okay? So therefore, whereas here, nobody can say anything about this. You cannot have a second opinion about this. This is the true picture of the history of FCX stock trading. And no one can dispute any of the data on this. This is objective data. So the third thing you have to look at is smaller cycles constrained by larger cycles. What do I mean by that? Let's look at this. Connected to the idea of zoom. High level zoom, low to low cycle. This I see only as a straight line, okay? And then dip. So what is the high level cycle? The high level cycle, low to low, 8-year cycle, okay? Goes up, comes up. Now, what is happening here is, if you see, let's look at one part of it. Now let's start looking at the smaller. So we see the high level cycle, low to low, 8 years. This I see as one straight line and one straight line. Now I want to start looking at, now I'm explaining this point that smaller cycles are constrained by larger cycles. Now this is the larger cycle, low to low, okay? Now the larger cycle has two parts, uptrend and downtrend. So now when we focus inside the uptrend, we start to see smaller cycles, okay? But we have to remember that the smaller cycles are essentially helping to trace out the uptrend part of the larger cycle. So the smaller cycle essentially is what is happening because the larger cycle is happening, okay? In the sense that it's kind of like, if you think of a very cyclical industry like cement or something like that, where if the Indian economy is going into a major recession or a major boom, the cement industry can't really be insulated from that, okay? Or steel industry, okay? They cannot be insulated from that because they are going to move with the larger economy, okay? So whatever money these guys have, so whatever money that ACC makes has to be less than what the total economy, the total GDP of the country is, okay? Because they are a part of that. So that's what we're trying to say here. The smaller cycles that you see when you start to zoom in is basically a part of either some uptrend or some downtrend, okay, of a larger cycle. So by definition, these things cannot basically violate the direction of the larger trend. which is a part of the larger cycle. Okay, so what I'm saying is, larger cycle is low to low, 8 years. And when we zoom into the uptrend of the larger cycle, we understand that the smaller cycle is helping to trace out, the uptrend part of the larger cycle. So therefore, the smaller cycle cannot move in a way that undermines the uptrend nature of this movement. Okay, so the smaller cycle can't start going like at this point it goes up and then starts going down below even the starting point here. It can't do that because it has to stay within a general uptrend trajectory, because what is the smaller cycle doing? It is actually just tracing out the uptrend part of the larger cycle. So one of the things you can be sure about when you are looking at the smaller cycles within a larger uptrend is that these fellows have to stay inside the uptrend trajectory. So if you are right, because obviously when this is happening, nobody knows that it will go up to this point. But if you make a forecast that it's going to go up to this point and you're a momentum player, and if you're right about that, then the smaller cycle has to keep moving net upwards. Okay, so therefore the next low can't go lower than the previous low. Next low here can't go lower than the previous low. Sometimes it does, but it has to eventually, it can't go, nothing can go below the lowest low. If your high level cycle is here to here, okay, and the lowest point is, say, whatever it is, let's say $3.3, okay. So once you start from here, the smaller cycles, no low can go below the 3.3. And generally it will not go below the previous low. You see that? Low, higher low, higher low, higher low, higher low. Okay. Here you have a higher low and you have a slight break, but if you take this and higher low, then higher low, higher low, higher low, higher low, all the way up. At some point this pattern will break. So what I'm actually guiding you towards is this. Don't worry, I have an alarm set up for the end of the class. We have a little time. I'll give you the first clue that you can use, and you will understand why I applied that rule earlier for setting the stop. So the first thing you notice is that when you start looking inside a trend, okay, you will see a pattern of higher low if you're looking at an uptrend. Okay, uptrend, and in the uptrend you will see, now there are 10 trend definitions. Okay, you will see later on that specific. If you read point number 4, that's what I'm coming to right now actually. Okay, so but I'm just explaining it to you visually, and then we will continue later on in the next class. But let's continue from this. So smaller cycles are constrained because it can't go beyond this limit. Okay, so I showed you higher lows because we have a long uptrend here. Higher low, all the lows are higher than the previous low. Okay, if you ignore this one point here, where was it? Yeah, this part. This low was broken at this point, but if you ignore this low, that's why the zoom level is important. We'll come to that later, but this is, so all the lows are higher. And what can we say about the highs? All the highs are also higher. Can you see that? All the highs are higher. High, higher, high, higher, high, higher, high, higher, high. Okay. All the highs are higher, all the lows are higher. And this leads us to our basic definition, which is point number 4, basically, that we are defining uptrends and downtrends. So we are going to define it. You can read it later on your own. I'll explain it to you visually. So this, from 3, we move to the definition of uptrends and downtrends. So you'll see all this now when you start looking at charts. Now you have different types of eyes. You see other things now which you did not see before. Uptrend, you will look for higher highs, higher lows. Okay. Conversely, downtrend, you will look for lower highs. Okay. Now don't memorize it, because then, like Betty bought a bit of butter, you will get completely confused. Always draw a visual picture and then explain it with English. Draw the picture first on a piece of paper or visually, then explain with English. Don't try to. Okay, your time is up. I'll just briefly wrap up this point. Okay, I'll just briefly wrap up this point. Uptrend, higher highs, read the notes for your own clarity later. Higher highs, but remember it visually. You don't need to read the notes. Higher highs, higher lows, uptrend. Downtrend, lower highs. All the highs are lower than the previous high. All the lows are also lower. Low, lower low, lower low, lower low, lower low. Okay. In this case, I think we did not make a lower low. But so now you know, downtrend, lower highs, lower lows. Uptrend, higher highs, higher lows. So you can put higher and lower outside the bracket and then put highs and lows. Higher, highs and lows, lower, highs and lows. Okay. Now try to see all these three things when you start looking at charts now. We will continue in the next class. Okay. And you can read this note for your guidance. But this is what we are trying to do. This will lead us to our TA method. Now we are coming to the point of the question is, what method will I use? If I choose TA, which method will I use? And I'll teach you a method in the next class. Okay, okay, so the class is dismissed. Anybody has a question can stay back, the rest can go. Yes, any questions? Saturday afternoon, no questions. Everybody wants to, and now of course you can't go out and party. That's the problem. All right, guys, anybody, any questions? What happened? Are you able to hear me?
Yes, sir.
Okay, good, good. This is the most important part of the class. Class is dismissed. Okay, so anybody has a question? The rest of you can leave.
Okay, thank you, sir.
Okay, sir. Thank you, sir. Thank you, sir.
Yeah.
Thank you, sir.
I had a question about value investing being a mean reversion approach. So, sir, how is it so? Because in mean reversion, we see that the trend is going to change, and what is it? How like uptrend is going to be a downtrend later. But, sir, how is it related to value investing?
Okay, so let me understand. Your question is, why is, remember if I, when I have, maybe I have closed that particular note, equity investing styles. Okay, at somewhere at this point, I have said value investing. This is what your question is on. Is this your question, Siddharth? That
Yes,
why did I make the statement that value investing is a mean reversion strategy? Is this your question?
yes, sir.
Okay.
Yes.
Okay. So let's go here. Okay. So let's give G is a very good example. Okay. So let's say I do my fundamental analysis of GE financial statements, projections of earnings, etc., and I come out with a fair value estimate of GE common stock as $20. Okay, and right now the price is 6.42. Okay, so obviously, what will I do? Will I buy or sell?
So we buy.
Yeah,
Fair value is 20.
yeah, fair value is higher than price. So I will buy, and the assumption is that it will move back eventually to fair value. Now, notice what happens when it's moving back towards fair value. Now, mean reversion. Mean reversion has two parts, mean and reversion. Reversion means going back. So if you call me, I'm busy, I say I will revert. Okay. So I will revert later or something like that, which means I will call you back. Okay, which is the sense of going back. Okay, I will come back to you. So reversion means going back. Okay, it's like going in reverse. So two parts, mean and reversion. Now, if you look at this, typically when you apply value investing, you are looking at some kind of price extreme. This is a price extreme, it's almost at the lowest. Okay. So if you look at this, especially the price data, especially the downtrend part of the price data, what do you think the mean of this is? Maybe the mean is somewhere around 35 or so, roughly you would say. Something like that. Can we say that?
Yes, sir.
Something like that. Okay. So now what happens is that, so you are buying it at 6.5 and your fair value estimate is 20. Okay. It could have been 35 also, but it is 20. So if your assumption is correct, then the market price will start to move back towards your estimate of fair value, which is 20. Okay. But as it starts to move back, what is also happening is that well, the mean, let's say, is 35. It is also reverting to the mean in the sense that it is going back towards the mean because it is at 6.5. If it goes to 20, it's not all the way to 35, but at least it is closer now to 35 than it was at 6.5. So it is going to trace out a pattern where it seems like it is reverting to the mean, that is going back towards the mean. That's why we say that value investing is an example of a mean reversion strategy. If you remember, basically if you remember what Sachin said about FCX, and he was talking about we should buy this now because the price is very depressed. Okay, if you go back to FCX and you look at the long-term data on FCX, okay. So what Sachin was saying is that I see this as the bottom of the distribution. So I'm going to be a buyer because I expect the price will now have to go back towards the mean. He didn't say it like that, but that's what he was thinking. Okay? So Sachin was also applying a mean reversion strategy on this time frame. Okay? So you have to keep the time frame fixed, but that's basically it. So he may have come up with a value investing strategy where he might have estimated that the fair value is 35, although I think that time he was talking more like a technical guy, like a TA person. But the same thing will apply. If I assume that the fair value of FCX is $40 and I buy it because the market price is 16, as it moves towards the $40, if you look at the downtrend, the mean price will be something around 35.40. So if I'm right, it will start moving back towards the fair value, and then it will look like it is reverting to the mean. Is this clear, Siddharth?
Yes, sir. So,
Now,
but I have another case, like if we see a uptrend, like the price is right now 10, we estimate the fair value to be 30,
yeah,
and we see uptrend going that from 10 it's going towards 20.
yeah.
So in that case, our value investing theory is also true, that the price is going towards its fair value, and also we are following a momentum theory, like there is a uptrend going
Yeah.
on, and
So
we are
yeah,
also going towards the market value.
yeah, I understand what you're saying. It's a very good question. Uh, so what you're saying, that's why I said earlier that it is very important to keep the zoom level, okay? The zoom level of the data set and the granularity. If you look at we have not discussed these terms, but the zoom, let's understand it only at the zoom level, okay? There are different zoom levels.
Sir, I get it. The granularity is like what time frame you are seeing and at
Yeah.
what level of details you are seeing.
Yeah, so there are two zoom levels we can discuss here now. If there are many zoom levels. So when I said that Sachin is following a mean reversion strategy because his estimate is fair value is 35, I have fixed the zoom level here. Okay, so this statement that because you see when the value investing guy makes up his mind, okay, about or even a TA person who is following mean reversion makes up his mind, he makes up his mind by looking at this high level chart, okay, and he decides that this will be going up because it must revert to the mean, and therefore we call it a mean reversion strategy with respect to this zoom level. Okay, that's when we say mean reversion, it is with respect to this zoom level. Okay, but your statement, Siddharth's statement, is also correct in that when you start looking at the last 6 months price action and you see how it will go from 16 to 35, when you just look at this zoom level, last 6 months, then as it goes towards 35, it will appear that it is a momentum strategy, okay, which is also a true statement. But the reason we say that the mean reversion is that value investing is a mean reversion strategy is that the decision is made with respect. That statement is with respect to the high level zoom. Okay, in any time frame, eventually for anything to make money, you need momentum because it has to move towards your target. Okay, because the price is not at your target. The price is already at your target. You can't make money. So, but it's a very good question, and so therefore you have to therefore lock down the zoom level. It's very important to be clear about the zoom level at which you are making that statement about mean reversion. Is this clear, Siddharth?
Yes, sir.
Okay, but it's a very good question because it goes to the heart of the application of this method and understanding momentum and mean reversion. Okay, any other questions?
No, sir.
Okay, all right. So we'll end the recording at this stage and see you guys in the next class. Any problems? Please make sure that everybody